Are you trusting Wall Street to fund your retirement, or are you building something you actually control? Well, what if I told you that smart investors right now aren't chasing deals? They're positioning based on where the economy is going next. And what if real estate isn't just an investment, but the solution to a broken financial system? Welcome to Raising Private Money. I'm Jay Conner, the Private Money Authority, and today you're in for a masterclass. You see, I've got Nic DeAngelo with me, known in the real estate circles as the fixed income GOAT. And this isn't just hype. This guy has built a portfolio north of $200 million across more than 20 states with hundreds of deals and loans under his belt. But here's what makes this conversation different. Nic doesn't just invest in real estate. He invests based on economic signals. He studies where the market is going and then positions his capital and his investors' capital ahead of the curve. He's the founder and CEO of Sane Investment Group, acquiring institutional grade assets nationwide and on pace to raise over $100 million a year. Yes, the name of this show is Raising Private Money. And here's the real reason you need to lean in. Nic has a gift for taking complex economic ideas and turning them into simple, actionable strategies you can actually use to fund your deals and build wealth. So, if you want to stop guessing, start predicting, raise private money with confidence, you're going to love this episode. In just a moment, you're going to meet my guest, Nic DeAngelo, right after this.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
Nic, welcome to the show.
Jay, great to be here. Great catching up with you beforehand. I've been looking forward to us getting to sit down and have some fun and talk about some good economic data and some capital raising. Two of my favorite things.
Yes, we are going to have fun. So let's go ahead and dive in. Let's start here, Nic. Are we already in the early stages of a long-term inflation decade? And if so, what are most investors still getting completely wrong about it?
Oh, man. Great question. And so let's dive in. First off, let me say, I believe yes. I believe we have upward pressures on inflation for the next decade plus. And there's a few reasons for that. There's actually quite a few, but here's the big ones. One, we are in a debt bubble in the United States. We are printing $2 trillion a year. That's on both sides of the aisle. We saw this under Trump. We saw this under Biden. We see we're printing $1 billion a day to fund a war in Iran, et cetera, et cetera. So across the board, we are overspending and we're not bringing in enough at the government level. The estimates are that we'll be paying $1 trillion in just interest payments on our debt in the next short amount of years. That's more than we even spend on Social Security. So that's one. The other side is that we have a baby boomer generation, the largest and wealthiest generation we've ever had, that is looking to safer, lower return, long-term investing strategies. So the days of cheap capital are behind us on that. And now what do we see in the marketplace today? We see that annualized inflation that we're looking at is right around 3.3%. And that's after 5 years that since 2020, we have printed over 80% of every US dollar that has ever existed in US history. We see that we see that $1 in 1913 is worth $100 today. So those are scary statistics to me. Those are scary facts to me. So the real question, I mean, you have a high-end audience, a sophisticated audience. How do you be on the right side of that for investing? What does that mean for the day-to-day American and investor, et cetera? These are big questions. But in my mind, if you look at the biggest names, Goldman Sachs, Warren Buffett, Morgan Stanley, they see stock market returns over the next decade not being what they were and what we've come to expect. And Most are projecting higher inflation on their side. I think it's going to be even a little more extreme.
Now, you talk about a debt bubble. What is a debt bubble?
So think about something that snowballs, right? One thing leads to another, leads to another. It's a spiral effect, if you will. Now, there's two types of spirals. There's upward spirals, positive things that, virtuous spirals, things that build them on top of themselves and go in the right direction. That's the opposite of the debt problem that we have in the U.S. today. The debt problem we have in the U.S. today is that we're approaching 40 trillion in debt. And the reality is both sides of the aisle have different ways of getting voters. And most of those, almost all of those, are on the efforts of spending more money. Okay. So on the right, consistently, we talk lower taxes. We talk, increasing business and wanting to do that, but a lot of lower taxes. And we do see some wars pop up on that end. And then on the left, there's not even a discussion about cutting government programs and cutting spending. It's spending more. So we really see that neither side has a solution to the debt problem we have in the US. And the reality is the top expenditures that we have, Social Security, Medicare, Medicaid, et cetera, these are very difficult to cut politically, right? So if you even have that discussion, which those top, 3 or 4 categories represent 75% of spending in the US, we don't have a solution to the debt problem. So if we extrapolate that out, knowing that we're unlikely to change, that $2 trillion a year that we're spending likely only ramps up over time, that deficit spending of $2 trillion a year. And now we see that our debt interest is only increasing over time. So this is a negative spiral. This is a downward spiral on the debt side. Our debt to GDP ratio is increasing. That's not good. I think the saving grace that we have here is the fact that no matter how much we can beat up on the US, and I do because I love the US, 100%. It's the most investable country in the world. It's not even close. If you compare the US, all the things we just talked about, to the rest of the world, it's so much worse everywhere else. So even though we need to get this on track, we need to get our spending on track, we need to get our debt problem in the US on track, we are still the premier economy. We are still the premier currency, and there's really not even a second place. So what does all that mean? We are in a downward spiral of debt that literally leads to inflation. And what we see on the American people level, what Americans experience day to day, is that their wage growth is exceeded by the amount of inflation that we have in the US today consistently. So that leads to more expensive cost of living. That leads to a lowered quality of lifestyle and quality of life. And so that's a concern. That's something that we need to resolve. And more government spending is not going to bridge the gap.
Is there actually a way, Nic, to resolve the problem of the downward spiral that you're talking about, even if politics could be put aside?
So at the simplest level, this is why I like economics, right? Is because there's core fundamentals. If you look at the spending problem in the US, it's really just a revenues versus expenses problem. So how do we resolve that? I don't have good solutions that are painless, but the solutions that we see are that we need to raise more money, likely by adjusting taxes to some degree. And then, and I'm not far off from that taxation is theft crowd. I'm not far off from that, right? So I'm more libertarian at my core. I'm a political independent. So on that side, that's a painful thing for me to say. That's probably bottom of my list of things that I find interesting from a political side. But we just don't raise enough in the economy. We just don't raise enough revenues. And the bigger issue, in my opinion, is that government spending's out of control. Whether that's anywhere from Social Security to Medicare, Medicaid, et cetera. Our solution in the past has been just to keep spending more. Now there's this discussion of tax the rich. Okay, here's an interesting stat, Jay. Here's one that blew me away. So we talk about taxing the rich in the US. What if we just took it to the extreme, right? Because there's a lot of hate on billionaires. There's a lot of hate on high net worths in the US right now. What if we took it to the absolute communist extreme and said that every billionaire in the United States, we rounded up every dollar that they had and stole it? The most extreme example possible. If we took every billionaire dollar and stole it. The reality is that equates to 9 months of spending for the US government. So that's a one-time theft, right? You can't do that twice. And those individuals with their brain power and their ability to run large scale businesses and employ hundreds and hundreds of thousands and millions of people, they're out of this country. They ain't coming back if they get thieved for, every dollar and cent that they have. So in that case, we know for a fact that just breaking the backs of billionaires doesn't get us there either. So at the end of the day, I see this solely, number one, no question, as a spending problem in the United States, and that we need to adjust government spending first and foremost to a way that makes us at least get into ranges where we can outgrow. Right now, that's not the case. Right now, our debt's growing faster than our GDP, and that's what keeps me up at night about the U.S. government.
Nick, you've said Wall Street is broken and real estate is the cure. I quote. That's a pretty bold statement. What specifically is broken about Wall Street, and why hasn't the average investor figured it out yet?
Oh, that's a good question. So there's a couple layers to it, but here's the core. If you look at Wall Street had a lot of advantages to the everyday investor for decades, right? For 100 years, we've looked at Wall Street as the great equalizer, because what it did was it gave us everyday investors, everyday Americans, the ability to own pieces, stocks, AKA own equity in large companies that were successful. They were, headline companies. They were well-known. They were highly trusted. The reality is that was a diversification play in many ways. The everyday investor could choose whether it was they buy a piece of, an ETF for the S&P 500, or they bought individual stocks, whatever their choice was, they could get into ownership of these companies and benefit from these companies' success. That has shifted, and that has not made headline news to the degree that it should have. So it's what we've seen since 1996, so in the last 30 years, what we've seen is the number of companies in the stock market has reduced by over 40%. Okay. So that's one shocking statistic on its own. Diversification is not the same word that it used to mean applied to the stock market previously. During that same window, since 1996, the amount of companies staying private and going with venture capital has gone up by 6x, 6 times. So we're seeing a huge drop in number of companies in the stock market and a huge rise in companies that are staying private and working with venture capital, investment groups, et cetera. So what does all that mean for the everyday investor? It means that the stock market is overweighted. It means that the stock market is less diversified than it ever has been. And if you look at the top 10 companies in the S&P 500, then what you see is that they represent over 70% of market value. So out of 500 companies, you have 10 that represent well over 2/3 of market value, and then 490 companies that represent 25 to 30% of market value at any given time. So diversification for the stock market is out the window. If you look at the last 12 months of the stock market, we're up in the high 30s range of returns. Now, I don't think anybody would argue that 500 companies in the US are doing 38% better as businesses. So what does that mean? It means that in the US, we are addicted to looking at the stock market as the most investable asset class. It used to be stocks and bonds. Bonds have some concerns right now, and a lot of people aren't going that direction. But the stock market is not what it used to be. Simply put, when you dig into numbers like the CAPE ratio, things that are, comparing the cost-adjusted price to earnings ratios, we can see from third-party metrics if the stock market is overvalued. What the CAPE ratio shows is that the stock market is roughly overvalued by 35 to 38% today. So all those gains over the last year are basically putting us into an overvalue, overheated stock market territory. So that's my biggest concerns. That's the core concerns that I have with the stock market right now. And then you layer on things like the fact that every company that mentions AI is getting a huge boost to their price to earnings and all these buzzwords rather than sticking to fundamentals of business.
Makes a lot of sense, Nick. Now, one thing you do is you invest based on where the economy is going, not where it is. So what are some, maybe 2 or 3 economic signals you're watching today that most investors might be ignoring?
Sure. These are the trends we're seeing. And I'll give you the background of why we have this approach and why we look into this approach. My background's real estate. I'm a real estate dog. So just to be real clear, my bias is that I like real estate mostly, or one of the top reasons is because it's a physical asset. So when we look at inflation trends over the next year, or excuse me, over the next decade, and we expect that inflation is going to have upward pressures, which we're seeing right now, then what we see is that hard assets, physical assets, things that you can touch that are real, typically benefit from inflationary environments. And we have a long history in the US of seeing that. So one, I like real estate. Two, I used to invest on the syndication side. We are pros at the industrial space specifically. I love industrial in the United States. I'm a huge fan of bringing manufacturing back to the US. And I think that honestly is a solve for a huge amount of the problems that we see today. But the biggest question I had on the syndication side was that I work with very sophisticated investors, and it's a blessing, but it's also a chin check. So when we work with, I started off with 2 family offices that I worked for. I ended up running their acquisition divisions. I ended up running their asset management. These are people that I'm dear friends with to this day. If there's one thing that I took away from these multi-generational family offices, it was this. You need to be thinking a decade plus ahead. These guys think generations ahead. It's extremely impressive. But what I saw, the trend that really alarmed me and concerned me and really readjusted our sights, was they were shifting to fixed returns. They were shifting to stability over craziness in the marketplace. And that's what I think we're seeing in many different markets today. That's what I think the story of the last 5 years has been, is really the everything bubble, where everything's overpriced. There's inflation across the board for asset classes. So the trend of inflation that I kind of mentioned prior, I think that the action on the back end is to find things that benefit from inflation. I think real estate's going to be the premier asset class there. And what we leaned into was one thing above all else, was investing into the debt behind real estate. So it's investing into real estate. It allows us to be in multiple markets at a time. I think single family homes, for all the crazy headlines up, down, sideways that you see on single family homes, I think the fundamentals of single family homes over the next decade are the strongest investable asset class in real estate today.
Now, why do you think that?
So single family homes are a absolutely blessed asset class in the US. And I can go through, an infinite amount of reasons, but back to economic fundamentals, supply demand, right? If you look at single family homes, we have a consistent demand. We have a consistent demand over time. And on the supply side, we have a shortfall. So we know from supply demand imbalances that if we have a shortfall on supply and we have a high consistent demand, that pricing stability is typically there. The shortfall is anywhere from 4 to 6 million homes that we have in the US. And the back end of that, what we've seen is that there is significant, huge amounts of price increases in single family homes. If you look at the last 5 years, where we've also printed $2 trillion a year during that period of time since 2020, 6 years, then what we've seen is that there's a huge increase, a huge run up, roughly 47, 50+% in the value of single family homes in that short period of time. On one hand, that's a nightmare for first-time home buyers. Let's just get that out of the way. This is an extremely difficult time to be buying your first home. It's extremely unaffordable. We've seen rates jump up significantly, et cetera. But on the other hand, there's the benefit that we have the most amount of equity in single family homes that we've ever had in American history. So I think that supply shortfall of 4 to 6 million homes is creating a very investable environment to invest in single family homes. On our side, we like the debt component. It allows us to get in. It allows us to increase returns beyond owning, 600 homes or something like that and having to manage those from an asset management standpoint. So we found that as the perfect fit for long-term stability. Again, we run a fixed income fund, so we're looking 10 years in the future. We need to make sure we can continue to produce for our investors on that side. And that's what we found as the best asset class in real estate today.
You may know the name Jason Hartman. He's got an amazing podcast as well. Jason has a lot of the same type conversations that you and I are having. He's a good friend. We're in a mastermind together. And he says the same thing. He says, we're going to have a shortage of single family homes for quite a long time. right? Like they can't, like, even the builders can't keep up. And of course, it's not just single family homes. It's like housing, like housing in general, whether people are buying or they're renting or whatever. Now, Nick, you talk about income investing, having a 10x potential. Break that down for us. What does that actually look like for a real estate investor?
Sure. So the 10x potential that we're referring to is the stability that goes into it. So it's not necessarily a return perspective, right? You're not going to get 10x returns on fixed income investing, but the fixed income side of a portfolio, we're seeing rise dramatically. So when we see people take their portfolios as broken down, and you look at some of the biggest names, whether it's BlackRock, and you look how they're investing, and that real estate is taking up a massive portion of their portfolio. Let me back up. What we've seen over the last handful of decades is the 60-40 portfolio, right? 60% stocks, 40% bonds, right? The reason that was so compelling for so long was that when stocks were doing well, bonds were typically returning less. And then on the flip side, when stocks were having a bad day or a bad period, bonds were picking up the pace there, and they balanced each other out. It was a good strategy because they were non-correlated. They were reverse correlated is the term there. That said, what we've seen in the last handful of years is that they have started being more correlated. That removes that 60-40 portfolio advantage, not to mention all the things we already said on the stock market. So when you now zoom back in and you look at the big groups, the sophisticated investment groups that are, have entire teams just to analyze all the different levels of economic data, they are leaning into other asset classes. They are getting away from 60% in equities. They're getting away from 40% in bonds. They're replacing consistently their bond income, that fixed income component to their portfolio. They are putting the fixed income investment dollars of their portfolio towards other fixed income investment options. You see real estate, you see some other options there. And then on the equity side, they're putting that towards real estate more at a much higher rate than they used to do. So we see this consistently. BlackRock being, 10 plus trillion under management. They might know a thing or two. Their portfolio breakdown is available for you to take a look at. You can find that online. Another one that I think is a more broad scope that's really helpful that I look at regularly, Tiger 21. In order to be part of Tiger 21, I think the minimum investable equity that you have to have, cash in hand, capital on hand, is something like 10 to 15 million, depending on which group you want to join in the US for Tiger 21. They have that same breakdown. They are shifting away to that. So the huge upside of fixed income investing is the fact that now you have higher returns than bonds generated from a fixed income perspective from things like real estate with long-term outlooks. And that allows you to take shots on larger upside opportunities on the equity side, things like real estate, things like that will generate over the next 10 years, higher returns on that side. They balance each other out in a similar way to that old 60-40 portfolio. So it's a similar concept, but it's updated for what the market conditions look like today. So that's where the huge upside potential is getting higher returns. That old, 4% bond is not looking as shiny when you have fixed income funds paying 10, 12% on that side. So you're already getting multiple increases on the fixed income component. And then you have the stability to go invest in bigger upside projects as well, many with tax advantages, et cetera. So we've seen portfolio breakdowns have 10x returns over the classic 60-40 just by diversifying and splitting their portfolio more towards other investment strategies that are outside of that traditional 60-40 bond stock.
Let's talk about the investors at large. I mean, they might be into real estate investing. They might be into stocks. It doesn't matter. Just for the investor at large, let's say you got an investor you're talking to and they're nervous right now. Uncertain markets, inflation like we've been talking about. With what's going on in the market, where would you advise them not to be putting their money over the next 12 to 24 months, and why?
So I'm an industrial dog on the real estate side. I've spent a lot of hours in the industrial side. What I've seen being close to that industrial sector is this concern of the impossibility of delivering on returns for AI data centers and for certain AI companies that are in the ecosystem. I think AI is a tool that will truly revolutionize business in general, but when you start drilling down into the components of many of these things, I think they're very overstated, to say the least. So my concern right now, where I would start holding a little steady and really kind of, sharpening the pencil on what that looks like, is if you're looking at AI projects, there's serious questions of where the hell does the energy come from? That's a very obvious one. There's one of how do these AI companies with record debt ever draw a real profit and have real net income in a positive way? So I think AI has a track record in the future that will be extremely positive and will definitely revolutionize many different aspects of the business world. But as an investable asset class, I'm looking at deal by deal with a lot of concerns and a lot of skepticism that the returns and the hype will live up to the expectations. That's the number one concern I see in the market today.
Well, now speaking of AI, as we know, AI is changing everything, when the internet was coming along, they were saying, oh, everybody's going to be losing their job because the internet's going to take everybody's job. And of course, all the internet did was create more job opportunities. I don't know if that's going to be the case with AI or not, but it's changing everything. How do you see AI, if at all, giving investors, because you're skeptical, you just mentioned that, but do you see AI now being able to give investors an edge or wiping out those who don't adapt? I don't know. What do you think?
So I'll give you the statistic that's pulled, I think, from an MIT study. They reviewed companies that went all in on AI. And many of these companies let go of staff. Many of these companies, downsized, et cetera. 85% of those polled found AI to have a net negative impact on their company. Okay. So I'll leave that there. I'll leave it to your audience to check out the details of that MIT study. But let me get back to more of a positive approach, because I actually have a positive outlook on AI net. The reality is, I think AI is misunderstood as far as what it's capable of today. I'll say that and, be upfront with it. I think AI is probably the most powerful tool side by side with a big brain, smart operator in the business world, whether that's a mid-level executive, whether that's somebody underwriting deals, whether that's somebody trying to distill and understand detailed points of a unique marketplace to invest in, et cetera. AI speeds that up infinitely. But I think it's a spot check on human work and human understanding. And AI is not a set it and forget it tool today. There's a lot of automations that it can do that are great with, marketing and, investor communications and things that we have a lot of benefits from and see a lot of value from on that side to make sure that things are sped up in a great way and efficient. But on the flip side, I do not see AI as a tool of set it and forget it. And Jay, you kind of said this with the internet, or if we go, way back and go crazy over the printing press or, any automations or robotics that's come up in the meantime. I believe that when you look at every technological revolution that we've had, the last 5 at least is really what I looked into quite a bit. It's created net more jobs on the back end. Not to say there's not pain periods, right? Because, I have a lot of family in Detroit, and I've had a lot of discussions with how it's impacted robotics, et cetera, machining, et cetera, has impacted the workforce in Detroit. Decimated, completely crushed in the auto industry, because when some individual used to screw in tires every single day, screw in wheels to cars every single day, that's now replaced by a robot doing that job or a tool doing that job, et cetera. So there are people that will be massively displaced. There are people that will be massively affected. But I believe that the net result of AI is actually more jobs on the back end. I think that we in the US do need to prioritize AI, even though there's a lot of companies that are concerning with how they're implementing that. I still think we need an AI focus, because being the world leader in AI, I think, adds a ton of jobs, a ton of GDP. And, we talk about debt bubbles. We talk about, not enough revenues for too much spending and expenditures on the government level. I think AI can really bridge that gap in a big way over the coming years if we lean into it. So I have a net positive over the next decade or so with AI. I think that it will produce positive results, more jobs, huge growth for the economy, et cetera. But in the short term, I think people are over relying on it and misunderstanding the capabilities of AI in the workplace. And you see studies like this MIT study saying 85% of those polled did not see net benefits of AI. And I think that's just from the fact that they are implementing it in the ways that it's not supposed to be or not ready for today.
Nic, I want you to fast forward 3 to 5 years. If someone follows your philosophy and plays this cycle right, what kind of position could they realistically be in compared to the average investor?
So I'll tell you what I'm doing personally. We run a fund. We get the ability to see all kinds of deals, all kinds of market trends from a boots on the ground perspective. I personally am investing in 2 areas above all else. I'm investing in the mortgage space in the US. I think the private mortgage space is exploding in the US because banks are unwilling or uninterested in really having large portfolios over a long period of time. I think banks have become origination machines today, and that they really lean on that when you look at where they're generating their revenue and their cash flow, et cetera. And I think the private lending space to real estate specifically has a huge opportunity over the next decade. So I'm leaning heavily into that side. That's where my investment dollars are going first and foremost. And then I think manufacturing in the United States. I think we understand both sides of the aisle. One of the few things they agree on. Yes, everybody's mad at China. That's both sides of the aisle too. And yes, everybody has, different opinions on basically everything else. But one of the things that we've seen from the Biden administration to the Trump administration is this focus on manufacturing in the US. And I think it's well placed. I think the reality is that if we bring manufacturing back to the US, it not only is national security on one side, but I think then we own and have incorporated huge value add and a whole chain of supply chain value down the line where that's shored on the US. So between those two things, I think real estate debt over the next 10 years on the private side, private companies doing debt is a huge opportunity, investing with those groups or doing it yourself. I mean, there's many opportunities there. And then on the other side, I think manufacturing and industrial in the US have the biggest opportunity over the next decade.
Nic, who is your ideal client to invest in your fund, and how can they find out more about that opportunity to invest with you?
Sure. We love our investors. We shifted to retail investors and working with, a wider group of Americans. So here's who we see consistently that we're the best fit for and that we get to have, the best conversations and provide the best solutions for. The first, we see people that are looking at, typically these are retirees, right? But are looking at taking less risks and want more consistency in their portfolio. That's my investment philosophy. So I align very well with people that are trying to build a long-term outlook on their portfolio with fixed returns that are something that are a lot more stable than the volatility in other markets. That's one. The second that we see are sophisticated people that are active in the business world, that are not moving into retirement or in retirement, and that just are taking enough effort and enough interest and maybe even risks in their business to continue to grow and add, great value to the US and US economy. Those people want consistent returns on the back end. They want to know that the money that they make day in and day out is placed in something that's consistent and long-term focused. So between those two groups, that's the vast majority of our investors. So I get to learn from our investors every single day, what they're doing, what industries they're in, what their outlook is. And those two groups, we really, really service very well at Saint.
Oh, that's great. How can they contact you?
Sure. The best place. So we dig into a lot of economic data, Jay. This is a passion of mine on a personal level. And then we also want to provide this for investors so that they understand what's going on in the world, behind the headlines, behind the news. And we just released a book. Our book is called Economics Over Politics. The goal with the book is to drill down specifically into the biggest trends that are being missed in the news today so that investors and Americans understand the drivers of the economy that are not being talked about. So they can find our book, Economics Over Politics, at saintinvestment.com/book. I highly recommend they check it out. We spent a year drilling down into these economic trends, compiling all the data, putting it together. So saintinvestment.com/book, they can find it and they can find a link there. And I really hope they check it out.
Awesome. Take advantage, folks, of what Nic is offering you there. www.saint, as in a Christian, SAINT, saintinvestment.com. Is that plural or singular? Do we have that right, Nic? Saint Investment?
Exactly right. Exactly right.
Perfect. saintinvestment.com/book. Nic, thank you so much for joining me here on the show.
Jay, I had a blast, my friend. Always good to connect with you. God bless and have a good day.
God bless you too. Now, this is Raising Private Money. And if you're a real estate investor, you're looking to raise private money, one of the common questions I get is, Jay, how in the world do I start conversations with a potential private lender to fund my real estate deals? Well, guess what? I have a free gift for you. It's my Private Money $1 Million Script collection. The very first script is called the Curiosity Opener. It'll tell you exactly how to start a conversation with a potential private lender. You can download that for free at www.jayconner.com/scripts. Again, that's jayconner.com/scripts. And that'll get you talking money right away. Well, there you have it. If you listen closely, you just didn't hear a conversation between me and Nic. You got a roadmap. I'm talking about a roadmap on where economy is headed, how to think differently about investing, and most importantly, how to position yourself to win while everyone else is still reacting, right? So here's the deal. You and I both know someone right now who is confused about the market, worried about inflation, or still stuck believing Wall Street is the only or the best path. Look, do them a favor. Take a quick second right now, hit the share button, and send them this episode, because this conversation could completely change how they invest, how they raise money, and how they build wealth. And hey, if this episode gave you value, make sure you subscribe to Raising Private Money so you don't miss what's coming up next. I'm Jay Conner, the Private Money Authority. I'll see you right here on the next episode of Raising Private Money.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jayconner.com/money guide. That's JCONNER.com/money guide. And download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jayconner.com/money guide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.